So let's start. So first thing first, tell me your level of comfort for derivatives so that I would know from where to start and where should we go
Quite.
about it.
I mean, I remember all of the various instruments. I think obviously no call, put option, etc. I also remember the various rates of change. Like I just need a brush up on it, but like theta, vega, and all of that. I remember all of that. Swaps, I'm not. I do have some understanding, but I just need to again brush up on.
So that's fine. I mean, let's not go too far. What I was
Yeah.
concerned about mostly is that are you okay with at least call?
Yeah.
Good.
I'm okay with call. Yeah.
Yeah. So let's just quickly talk about how do you define a call, by the way? Let's just do a quick brush up.
So call option is anything that you have the option to buy something at a certain price. So it has like, convexity. So there's upside optionality in a call option.
So what's your motivation to get a buy? So what's your motivation to buy a call option?
So the motivation is you kind of believe that something's going to go up, like the stock price of a company is going to go up. You can buy a call option.
So you believe or
and
you
if
don't believe?
you believe that the stock is going to go up, and so you've essentially have the option to buy it at a cheaper price if the stock does go up and pocket the returns from there.
My whole point is that why don't you buy a stock if
Uh,
you're really
yeah, because
optimistic?
you it's a levered bet, so you can have the same underlying quantity for lesser amount of money, I think. Yeah, so that's why you buy an option.
Yeah. So let's talk about this. So when you say that you have a call option, this call option actually gives you a right to execute. If you are buying a call in derivatives, the nomenclature goes as if you are buying something, you are long.
Yeah.
And if you are selling something, you are short. So when I say that you are buying a call, you are basically long a call.
Yeah.
And when you say that you're long a call, it clearly means that it will give you a right, but not obligation. Not obligation to buy to execute the transaction.
Yeah.
And why is that? So, and that's a whole bigger motivation of buying an option is because when you say that you are long a stock, let's say let's talk about NBCC, right? The stock price is 100 rupees. While you think that the stock price would go up, and then you can obviously buy a stock worth rupees 100, right? But just in case it goes down, when you invest your 100, you have invested 100 rupees, and what if the price gets half? Your equity is worth rupees.
Yeah, you're downside protected over here, like your losses are protected.
However, when it comes to call,
yeah,
and the premium that you pay is pretty less. So let's say for a strike price, and I'll come to that in detail. Let's say for a strike price of 105, while the current stock price is 100, the call premium is 10 rupees. Not really 10, but 3 rupees.
Okay.
So effectively, you only have to spend 3 rupees to get the right to execute a transaction when the stock price goes up to 105. Right? Now let's just quickly look at how does it really works. So obviously, when I said that the strike price is 105, basically you have paid a premium for a situation when the stock price goes above 105. So that's your strike price. While the current price is 100, as I said.
Right.
And I said that the call premium is 3 rupees.
Yeah.
So effectively, you will execute, or you have a right to execute your trade when the price goes above 105, which means that when you have a price which is 100, is it too thin to look at?
No, I can see.
Right. Okay.
Yeah.
So this is 100, this is 101, 102, 103, 104, and 105. Right? So while till the time you have the price 105, you don't have anything. Basically, you don't make money. So basically, I'm saying that it's a flat line. However, the moment it increases from 105, your profit starts increasing along with the stock price.
Yeah.
So this is called as you are long a call. One thing I'm trying to make a point here is that this graph that I just showed is basically a theoretical graph. Why am I saying it's a theoretical graph? Because we didn't look at a point where you effectively paid 3 rupees as premium. How about that? So let's say and obviously I just missed to tell you, every option has a time to maturity. Because think about this, right? Everybody knows that the world is moving forward. So obviously everybody knows that the price is going to go above 105 someday. Right? But the idea is when.
Yeah.
Right? So in that case, and the seller, obviously, even he's taking the risk in selling you this, because what happens is when you say that the price gets 110, the assumption here is that when you are long a call, somebody is short a call. By the way, a lot of people get confused, and then you also let me know, and don't hesitate to tell me. A lot of people think that the opposite of long call is short put. A lot of people think that, right? But it's not. It's not. The opposite of long call is short call. Think about this. If you are paying money, somebody is getting money.
Yeah.
Right? So the point I'm trying to make over here is that when you say that if the price goes 110, the assumption goes that somebody who has got the premium, will effectively have to buy the stock at 110 from the market and give it to you for 105. Right? Somebody who is short the call would effectively buy the stock from the market at the same moment at 110 at the time of expiration and would hand it over to you for 105 because that's agreed price. Right? So before we look at the short calls payout, let's just think about what if the price is still 103 by the time it expires. So think about this. The time of let's say the time to expiry, the time to maturity is 3 months. Right? But then this 3 months happen after 3 months when the time is 3 months, right? But you paid the premium right away.
Yeah.
So you effectively -3 immediately.
Yeah.
And that goes out of your pocket. Which means when I say that your payoff is 0 till 105, it's not effectively 0, it's effectively -3. You are at a loss till you break even.
Yeah.
Now, even though the price is 105 and I said, okay, after 105, your profit starts increasing, right? But that's actually your profits theoretically, but your payoff is not at 105, but effectively at 108.
Minus.
Does it make sense?
Yeah.
Right? And
Makes
hence,
sense.
you will see a parallel line along the curve. Right? So your payoff, when it comes to profit and loss, your profit at 110, your profit at 110 is going to be how much? So this is how it goes. There's a formula, and then we should all keep note of this formula.
Okay.
For a call, obviously for a long call, the profit that you can say is max of st minus x, comma 0.
Yeah.
Right? So in this case, you can put any number in this and then you will see what the result says. Let's say when it is 103. So it is max of 103 minus 105, which is our strike price, and 0. Obviously, the max of minus 2 comma 0 is 0.
0.
Right? While in that case, when I say it's 110, so it's going to be max of 110 minus 105 comma 0, which means it is 5. But then be mindful of this, that this is just your payoff, but when it comes to profit and loss, it is inclusive of your premium that you paid. So effectively, your profit is going to be 2 rupees only at a price at ST is 110.
Got it.
And be mindful of the terminology. So they use the terminology S0 as the current price. In this case, it is 100. They said C, small c, as the call premium, which is 3 in this case. They say ST in this case, which is 110 or maybe 103 that we discussed. And time to expiration, obviously, it's T, which we said it's 3 months. Right? Now, one more thing before we wrap up this topic. When I say that we are a long call, and I said if you are giving money, somebody is taking money, and when the price would improve, when the price would increase, your profits will increase. At the same time, somebody who is short a call, again, his or her payoffs are 0 till this time, and the more the price would increase and your profit would increase, his loss would increase. That's the reason we say it's a zero-sum game. Right? And similarly, if you really want to go to get the profit, etc., and then when you pay off for a long call looks like this, obviously, when you made a loss initially, somebody actually made a profit.
Right.
And the payoff should be like this. Right? So this becomes your short call, and this becomes your long call. Is it totally clear?
Yeah.
Okay. Let's move ahead. Let's quickly analyze a put option, similar to what we just did. Right? What's the motivation to get a put option?
It's to basically sell at a particular price. You have the option to sell an underlying at a particular price in the future.
And why would you do that?
You would do that so that mean, essentially you think that the market will go down, and then you have set a price in the future that assures you a certain return. You have the option to sell at that price when the market's down. So like suppose something is trading, you have a put option, strike price is 100 and then the market falls to 80. So you're short the market. And again over there, you have the option to execute the trade. So you just pay the premium.
Right.
And yeah.
Okay, very good. One word that I want to pick from what you said. You said that you are short the market.
Yeah.
So this word is a serious word in derivatives. Right? When you say that you are short the market, it means somewhere you are writing an option.
Okay.
Right? It is not equal to buying an option.
Okay.
Because buying an option is long, while writing an option is short.
Okay.
Right? So when you say that you are you have a put option and you are long put, the long puts are rare. Right? Not that I'm saying that it doesn't the transitions won't happen, but it's rare, and because of the fact that the lower bound is fixed. What does that mean? Even if the stock price goes down, you have a limited profit because the worst it goes is zero.
Zero. Yeah.
Right? While you say that a long call has an infinite upside potential,
yeah,
when it comes to put option, you only have a limited profit. And obviously, you rightly mentioned that the motivation here is that we think that the market is going down. So how about that I spend some money on the transaction where I have the right to execute the trade if the price goes below a certain level, right? So let's just quickly look at whatever we are saying in terms of the payoffs. Again, let's talk about current stock price is, let's say, current stock price is, let's say, again 100. And the strike price this time would be 70. And for this, you have paid a premium of 5 rupees. Right? Now, how about at the maturity, what if the price is 90 and what if the price is 30? So again, the formula to get this done is very similar to what we've done in in call. It is max of x minus st, comma 0. And the idea is very simple. Even if we don't remember the formula, etc., right? We can always visualize and think what's going to happen. So my immediately what I've paid is 5 rupees. So I am already -5.
Yeah.
If I'm a long put.
Yeah.
I'm already -5. And then when the price goes 90, I end up being at a loss of 5 rupees, which because the option expired out of the money. Right? And when the price goes 30, right? When the price gets 30, now in this case, look at this one. My strike price is 70. My current price is at the expression is 30, comma 0, 40. How much I have paid? 5.
Yeah.
So at this price, 35, that's your actually profit. At the same time, you didn't even buy a stock.
Yeah.
Right? So that's how you took the opportunity to take the downside of the stock. right? Let's quickly look at the payoffs the way we did for call, right? For a long put, what does this mean? When the price here is, let's look at the same example, right? When the price here is, tell me, how does it look like? What should be the price over here, by the way?
It should increase to the right.
Okay, it should increase to the right. So are my profits increasing or decreasing in the right hand side?
They're capped at the loss of how much you pay for the tree.
Okay. So the cap at the lower side.
Yeah.
Right. And so how this works is, let's say this is 100, 90, 80, 70, 60, 50, 40, 20, 20, 10, 0. Right?
Yeah.
So when the price is going down, right? When the price is going down, you don't make money. But below 70, you start making money till it becomes 0. So as I said, your
upside is
you will limit your profits over here.
Yeah.
That's all you can make. And very similarly, when you are long a put, somebody is short a put. Right? The payoffs are mirror image. So far, so good?
Yeah.
Any questions so far?
No.
Okay. One more thing, a small terminology, something that you already would know, but just a refresher. Is your ITM, OTM, and ATM. Right? So, how about OTM for a long call and a long put?
So OTM would be basically long call would be out of the money. That means that the underlying price is more than the underlying price is lesser than the strike price of the call option. Long put would basically be out of the money would be that the price of the underlying is more than the strike price of your put.
The price of the underlying is more than the strike price.
Yeah, for long put.
For a long put. For OTM. Perfect.
Yeah.
Okay. And you understand what the ATM is, right? When it is equal to the strike price.
Got it. Yeah.
And when you're making money, you are effectively in the money in wherever situation you are. In wherever situation you are, whether you are long, whether you are short, whether you are or whether you are put.
Got it.
If you are making money, you are in the option. Right? All right. Assuming this is all done, there's one more term that your book mentions. Something called as uncovered or naked call. Right? What does this mean? It is very much in line with what we have just discussed. When you are long a call, we discussed that your upside is unlimited. So think about a person who is actually short a call. Don't you think that his losses are infinite?
Yeah.
So if and I said, usually what they do is they buy from the market at that moment, and then they sell it to you at a strike price. So effectively, think about, again, this is very theoretical. It doesn't happen that much. But think about this, that when they talked about, when they sold the call, the stock price was 100, but by the time it comes to maturity, the stock price gets 1 lakh. So effectively, they will have to buy at 1 lakh and sell it to you for 100 rupees. Right? So if somebody, not you, you are long a call. If somebody who is selling a call is only selling a call without making any other transaction, it means he is an uncovered call.
Got it.
Right? Because his losses are uncovered. Now, there are different ways to do it. He can also buy a call. Think about this, and we can talk about this later in different strategies. But without getting into CFA, without getting into the curriculum and the exam, think about from a Marwadi or Banya perspective, right? That if I have sold a call, let's say for a strike price of 105, right? What I can do is either I can buy a stock right away.
Yeah.
I can long a stock.
Yeah.
Or maybe I can long a call at maybe 110.
Yeah.
Right. So what happens is from 105, I start making a loss from till 110.
Yeah.
And after 110, I'm a long call. At least that offsets. So effectively, while writing a call, if I have earned, I'm looking from a perspective when I'm selling a call.
Yes.
From that perspective, let's say if I earned 2 rupees.
Yeah.
And then we will talk about this later, that if the current stock price is 90, for a strike price of 105, if the call premium is 5 rupees, for a strike price of 110, the call premium would be 2 rupees only. So it is 2 rupees. So think about this. I received 5 rupees and I paid only 2 rupees. Make sense?
Makes sense.
So I received 5 rupees and I paid just 2 rupees and I just hedged my position. So the only loss that I'm going to make is effectively in this whole strategy, the maximum loss that I'm going to make. I was saying towards the end that I have hedged my position.
Right.
The maximum loss that I could get from the transaction, I'm not considering premiums for now, but 5 rupees. Is that correct?
How did you get that? How did you get that? Yeah. 5 rupees. Correct.
5 rupees, right? Because I am short a call at 105.
Yeah.
And I'm long a call at 1010.
Yeah.
So effectively, it's just 5 rupees. Now. Here's the story. It's still not 5 rupees, right? Because 5 rupees is from the payoff. But I have also received plus 5. So this is negative 5. This is plus 5. And I have paid 2.
Yeah.
So effectively, just by paying 2 rupees, I have hedged my whole transaction. The maximum loss that I would ever have is minus 2 rupees.
Is minus 2. Yeah. Correct.
Makes sense? Because this minus 5 is assuming, I'm assuming that the stock price at the end would be 120. I'm looking at a scenario where assume that it is 120. Even at 120, when I was short a call, I would end up paying max of ST minus X, 0, which is 120 minus 105, 0. So this is 15 is what I'll pay. But I'm already long at 110.
Yeah.
Right? So 120 minus 110, 0. So it's positive 10.
Yeah.
So my minus 5 comes from here.
Correct.
Right? And then I have already received the premium from you because you are long a call plus 5.
Yeah.
And I've paid the premium minus 2. So no matter where the price goes, my maximum loss would be 2 rupees.
Yeah.
Make sense?
Yeah.
Again, they call them different names, but the idea is the same. And
so
we're
this
not talking
one
about
is a covered call. This is a covered call. Oh.
no, we'll talk about that. We'll talk about that.
Okay.
Okay. Yeah, but this is in a way is a covered call.
Okay.
Usually covered call says that we will long a stock.
Okay.
Instead of buying another stock, another option.
Mm.
All right. Now, let's talk about some technical jargons. The idea is the same, but how they define it, let's see that. So they call them as synthetic options.
Mm.
Why word synthetic? So synthetic basically means that you are artificially doing something.
Mm.
You are artificially doing something, right? Let's take a very simple example. You want to buy a stock, NBCC, worth rupees 100.
Mm.
So you spent 100 rupees. Now, once you spend 100 rupees, how the payoff would look like? Right?
Yeah.
Makes sense?
I think isn't your yeah, downside is -100, right?
Absolutely. No.
Yeah.
So yeah. So this is 100. So the price increases, your
Mm.
profits increases.
Yeah.
If the price goes down, your losses increases.
Right.
Till it becomes zero. Right?
Right.
So this is a standard way of buying a stock where you just went to your Zerodha or somewhere and you bought a stock worth rupees 100, and this is how your payoffs look like. So this is like a real transaction. Now what they say is, I want a similar payoff,
Mhm.
but using option. In this time, in this whole transaction, you will end up spending 100 rupees.
Yeah.
Right? So they say, is there a better way? Is there a better way to achieve the same payoff, but by paying less?
Mm.
Right? How do you think we can do that?
So on the right side, you can you do a long call, and then on the left side you perhaps do a short put.
Short put, okay. So let's look at this. When we discussed initially, this is my long call,
Yeah.
this is my short call,
Yeah.
this is my long put,
Yeah.
and obviously this is my short.
Right.
Now, if just take this along, okay, and shift it a little bit. Try visualizing that you are shifting this. Keep this intact. If you keep shifting this, like this, like this, so there will be a moment where it will somehow be looked like this. Yes,
Mm-hmm.
which is as good as this is zero, this is zero, and what you get is here.
Mm-hmm.
Right? So you rightly mentioned this is long call and this is short put. A long call and a short put will give you a payoff which is exactly similar to your longer stock.
Mm.
But then in a long call, you paid the premium,
Yeah.
and in a short put, you actually receive the premium.
Yeah.
And obviously they will not be same depending
Ah.
upon what the price would be.
Ah.
But I can guarantee you it will not be equal to 100.
Hmm. Hmm. Hmm.
Right? It will not be equal to 100. So effectively, let's say the net that you paid is 20.
Hmm.
Instead of paying 100 rupees, you paid just 20 rupees and you got a similar, not similar, but exactly same payoff
Right.
from both the two options.
Got it.
And then what they also say is that when you write a put option, in this case, you are writing a put option, right? Right? Obviously, you're writing a put option with some exercise price. Everybody does that.
Yeah.
And let's say you put you write an option, which is put option for a strike price of 70, right? And then you put this 70 in the bank.
Okay.
Just to be secure that let's say you wanted to, let's say the person who is long the put is really going to execute the transaction. Assume a situation where the person who is long the put is going to execute a transaction. In that case, you will have to end up paying him 70 rupees. Is that correct?
Yeah.
Right. But then if you have secured your 70 somewhere, mentally you are safe that no matter what would happen, the worst case scenario is I will have to pay 70. My 70 is secured, right?
Correct.
This transaction, when you do that, it is called as cash secured put. And the reason is very simple. Everybody wants to make money, and obviously he would have assumed that the price will not go down. But just saving enough money for the worst case scenario, right? And if you don't do that, it is called as naked.
Naked what? Sorry.
Naked put.
Naked put. Got it. Yeah.
Right? Make sense?
Yeah.
And the reason is very simple, because ultimately you are not hedging. Again, I was saying that you could have replicated the whole profit and loss scenarios, but then at an individual level, when you are long a call, you are safe. Worst case scenario, your option will go expire. That's the worst case scenario.
Yeah.
But in a short put, you have an obligation to redeem. Right? So if you don't do anything, you are naked put. But if you put enough money in the account just to be safe, it's called as cash secured put.
Got it.
Now, one thing that I kept on saying, that we paid, I kept on saying that I paid the premium and at ST something is happening.
Yeah.
But when it comes to finance, etc., when I say that you are really managing the money, then you also have to think in real world terms that the money that you are paying is right now at time t equal to t. But whatever transaction would happen at t equal to st. So while keeping things simple, we just say that your profit payoff is 5 rupees minus the premium paid is 2 rupees, and then your profit is 3 rupees. But what we don't consider is that the amount that you paid as 2 rupees as premium has been paid at t equal to 0, while the amount that you get at t equal to t is 5 rupees. They are not same. The time has lapsed. Right? So effectively, there are two ways of doing things. Either you bring everything over here and then you subtract or add whatever, or maybe you take everything over here. The idea is simple, that you have to take care of time value of money.
Got it.
And I hope that a put call parity clearly tells that. You must have covered this CFA level 2.
Yeah. I basically either the call premium plus either the discounted value of the underlying equals the put premium, something like that. Yeah.
Okay. I'll make it simpler for you. The idea is very simple. When it comes to put call parity, it says that you buy a stock right? When you buy a stock, what's your risk?
That it goes down to the amount you bought it at.
Totally, right?
Yeah.
That's the only risk. If it goes up, you're happy.
Yeah.
If it goes down, you have a risk. Let's
Yeah.
buy a. So you're safe, right? So you are buying a stock and you are protecting your downside.
Yeah.
So effectively, if this cancels out,
Yeah.
you are as good as buying a long option,
Yeah.
right? Plus the premiums, etc., that you paid,
Yeah.
right? And then this will say that you paid the call premium, and then your earnings would be the strike price, but then taking back at a present level. So they say that a put call parity talks about protective put and a covered call. We'll talk about this in detail. What are protective put, what are covered calls? We'll talk about this next. But the idea is that these two equations equate, and you must have used the put call parity in calculating one of the
Yeah.
three variables.
Right.
Again, the focus on CFA level 3 is not to calculate the put call parity or maybe at the variable, but just to tell you. Okay. Let's just quickly look at a question so that you would know.
Yeah.
By the way, which book are you following? Are you following Scherzer by any chance?
Schweizer, yeah.
And do you have it handy already?
Yeah, the volume 4, right?
Should be 1 second. Let me get the book.
Yeah, yeah. Sorry, I'm so sorry. I have this, it says the CFA program curriculum. So
Oh, you
that,
have the curriculum books.
yeah,
Okay.
yeah,
So
not
even
sure.
better. Okay, okay. Yeah. So they are not Scherzer books. They are curriculum books.
I have the curriculum one, sorry.
So I mean that's too much of a volume to cover. Why did you get these books?
Is it better to get the Schweizer notes, is it?
No, I'm just saying that obviously the CFA curriculum is any day better, any day. But then, given the time that you have, I think the Scherzer was.
I see.
Had it been 6 months before, I would have said, okay, just try curriculum and try all the questions. The volume is voluminous. I mean, it's too big to cover.
I see. Yeah. That portfolio management book only is so thick, but thankfully I finished it, and I'm
Okay.
almost also done with my private market. So a lot of the weightage of like say 30%, 40% I've covered with those two, and yeah, hoping to whatever topics we have that should also add. And then I think I'll just be left with ethics, which I'll just have to brush up again. And yeah, I think any other big one I'm missing out. No, I don't think so.
No
So
worries. So
yeah,
at least we'll try to cover as maximum as we can. So let's just solve a question here, and
yeah,
let's see. Do you have a pen and a paper to scribble?
yeah. I have.
So there's a dealer. I'm not writing the whole question though,
Yeah.
and I'll try from next time if I can get a PDF so we can just I can because the reason why I want to do that is I want you to read the exact language that you would see in the exam. That will make you accustomed to the wording pattern.
Yeah. Yeah.
So for now, I'm just calling it out. So basically, there's a dealer who has sold a 4-month forward contract, right? Forward contract to a person who would purchase who would purchase 1,000 shares of a stock at 179.59.
Hmm.
The current share price is 179.
Okay.
Right? Interest rate is 1%.
Okay.
And the call and the put is same as 16.34 per share. Right? So the idea here is that this person has sold 4 months contract.
Yeah. So the other person has the option to buy it, but if he exercises it, no, he has to, right? He has to buy it in the forward.
Yeah.
Yeah.
So effectively he can default, because in forward they can default, in futures they cannot. It's a
Okay.
mark to market. But assume that he will not. The
Default.
idea is not to tell you that he will default. So the idea is that he will buy.
So he needs to have the underlying.
Correct.
Yeah.
So the person, the dealer, he has sold, which means he will have to give it to the buyer after 4 months. Right? So basically this is the dealer and this is
Yeah.
the purchase.
Yeah. Yeah.
Now, since the dealer has sold some contract,
Yeah.
how will he hedge?
Yeah.
Obviously, he will have to hedge the position.
Correct.
Now, when he has sold, what is the risk that if the price goes down?
Right.
So let's just talk about what if the price goes to 160?
Yeah. 19.59. He's lost. No, sorry. He's gained 19.59, right? Oh, no, not sure.
Okay. So think about this. When I've sold the contract, I'm looking from perspective of a dealer. I'm a dealer.
Yeah.
When I've sold the contract at this, effectively,
and you bought it at 160.
no, that would be at a maturity that I don't know yet.
Okay.
From a timeline perspective,
Yeah.
if it is a 4-month contract,
Yeah.
and this is t equal to 0, and this is t equal to 4 months. When I have sold the contract on this day, to hedge my position, don't you think that I should be long on the contract on the same day itself? When I have sold a contract, which is a forward contract, I should long
You
a
should be
call,
long. Yeah.
right?
Correct.
I should long a call. By the way, do you know that in a forward and futures, the profit and loss, they don't get truncated because the transaction will happen for sure.
Oh, okay.
So in a forward contract,
There'll be an exchange of the security.
Yeah. So in a forward contract, it doesn't give you a right or an obligation to either execute or not to execute. You will have to execute. Right? Again, the basic difference, and you would know already, and you must have read this in CFA Level 1, that a basic difference is that my forward is OTC product.
Yeah.
While futures is a standardized product.
Yeah.
Which means in forward you can default, while in futures you cannot, because there is a concept of MTM, mark to market.
Okay.
But the idea here is that we are not really concerned about that. In forward you can default, so he will not come and execute the trade. The idea is that in a contract, I'm not comparing forward versus futures. I'm comparing contracts versus options. So while the options give you a right to execute in terms of long and an obligation to execute in terms of a short, in a forward contract, the payoffs are very similar to buying a stock. It's just that we are fixing the price upfront. That's about it.
Got
So
it.
what we say is that if the current stock price is, let's say, 100 rupees,
Yeah.
and we fix the price for 105, so even if it is 95 or even if it is 125, you will have to execute, and the profit and loss will be defined accordingly.
Yeah.
But there's no way that you can get away with the contract.
Got it.
So now think about this. Now coming back to the original question, when I said that he has sold a forward contract, it clearly means that the trade would happen for sure. Now the only thing is that he will have to hedge his position.
Yeah.
And how can he hedge the position? How about that he will long the call at this price, right? And he will short a put at this price. Now the question is, why short a put? Longer call, we understand, right?
Yeah,
why is it longer call?
Because basically he's effectively set the right to buy, like the option to buy it at 179.
So there's no option. So there's no option.
Yeah, he has to buy it.
No, he has to sell, not him. Again, think from a dealer perspective. You are a dealer.
Yeah.
Think of it, you are a dealer, and you, okay, let's keep it simple. Let's not make it 179, let's make it 200. You are a dealer and I'm a purchaser. So you will tell me, Ankur, let's have a deal that after 4 months, I'll sell you at 200.
Yeah. Okay.
What's your risk? Your risk is, what if the price goes to 50?
50. Yeah.
What if the price goes to 250?
No, so as a dealer, you want the price to be lower, right, at that day.
But we don't know, right?
Yeah. We don't know.
We want it to be lower. But what if the price goes to 250?
Yeah. Then you're screwed. Yeah.
So as a dealer, how much will be your loss?
Your loss will be, if it's at 250, it'll be 50.
So your loss is just 50, right?
Yeah.
And it's my profit because we promise that you will sell me at 200.
Yeah.
So I'll buy at 200 from you. And I straight away go to the market and sell at 250.
Yeah.
Earning 50 rupees.
Yeah.
Now think about yourself.
Yeah.
How will you hedge that?
As someone selling a forward?
How does it help? Look, what you're saying is
no. Am I the dealer or the?
You're the dealer. You're the dealer.
Okay, so 1 sec. So
think about this.
So 200 I have to deliver. So goes to 250 and 50. Yeah, I think like you were saying that you basically then are long the security, right? The way
long
to hedge
security. Okay. How does it help?
So
Gaurav, let's talk about what's your risk. Obviously, we want to hedge our risk.
Yes.
So I said you are obligated, and we have a contract. You are a dealer. Just remember, you're a dealer. I'm a purchaser. We will talk about both the sides.
Yeah. So your risk is like unlimited. Like your loss
Whose risk is unlimited? Mine or yours?
The dealer.
You are a dealer.
Yeah.
So your risk is unlimited, right?
Yeah.
Why? Because if the price goes to 10,000,
yeah,
I'll still as a purchaser, I'll still buy you at 200.
Yeah.
And you will have to buy at the current market price and sell it to me at 200. Are you on the same page?
Yes, same page. Yeah.
Okay, perfect. Now, if you're on the same page and you understand that you have a unlimited loss, you could have unlimited loss, right? How about you buying a long option?
Yeah. So unlimited loss typically happens in like short call, right? So you have to do the inverse of that.
Yeah, I'm just saying that
no, long call, understood, long call.
Yeah, right. Because you just want to hedge your risk.
Yeah.
You want a situation. You want a situation that if the price goes up,
Yeah.
if the price goes up, very similarly, the payoff of that option should go up.
Yeah.
So that it offsets the loss that you're gonna make.
Yeah.
Makes sense? So a long call is a good strategy at 200 in this case, because even if the price goes 250, right? Your profit is 50 from the long call that you have just bought.
Yes.
While since I'm going to buy from you at 200,
Yeah.
so your loss would be 50 rupees loss. Effectively, you don't have anything, and the maximum loss that you would have is of the premium that
premium price. Yeah.
is upside covered.
Yeah.
Is upside covered. Okay. Let's talk about the downside. What if the price goes 150? What if the price goes to
150? Then you effectively you've made 50 from the forward.
You made 50, right? Why? Because the contract says 200.
Yeah.
As a buyer, I will buy from you at 200 only.
Yeah.
Right? So what you would do is you will go to the market. You'll go to the market.
Yeah.
You will buy at 150 and you will sell it to me at 200.
Yeah.
50 rupees upfront.
Yeah.
Right?
Yeah.
But the point is, you have to secure the transaction. You have already. You don't know if it is going to go on 150 or not. You don't know that.
You don't know if it is. Yeah, you don't know that. Correct.
What I'm saying is, you have already paid some premium.
Yeah.
While hedging the upside, I'm talking about you. Remember, you are a dealer.
Correct.
You have already paid some premium to hedge your upside.
Yeah.
How about that you sell some put? Okay. Now, how does this help? If you will sell a put, obviously you will earn some money.
Yes.
Now, let's talk about what happens. When you sell a put, you will receive the money.
Yes.
Now, in this case, if the price goes 150, right? When you sold a put to somebody, he will execute.
Yes.
The price goes to 150.
Yeah, he will execute. Yeah.
Right? When he will execute, you will have a loss of 50 rupees.
Yeah.
But then this person to whom you sold the forward contract, even he is going to pay you 200 for this.
Yeah.
So 50 rupees can be given from there.
Yeah.
Ultimately, you are at no profit, no loss.
Yeah. What if I hedge only through a long call?
But then you will end up paying some money, right?
Yeah.
It will cost you something.
Got it.
And the question clearly says that the premiums of call and put are same.
Got it.
So effectively, by doing a long call plus a short put will secure your transaction. And since premiums are same, it's the amount that you paid is zero effectively, and you hedge the whole transaction, upside and downside.
Okay. Yeah.
Now, obviously, even if the price goes down, you're not going to make the money, obviously. But if the price goes up, you're not making a loss either. Right? Putting it another way, you entering into a forward contract, instead of that, let's just longer call and shorter put. The payoffs are again same. That's just another way to put it.
Yeah.
Right? But the idea is that when we read a question, especially in level 3, I sometimes sit back for 30 seconds and I think, okay, what exactly do I need to do? Instead of thinking that I'm gonna long call and short put, which is difficult for me to interpret immediately. If I would know my objective, I want to hedge my position, then I think, okay, does it translate to some terminology? Right? When I know that I want to hedge my position, I want to hedge my long position. If the price goes up, it's going to be loss for me. So I would think of a product that will help me hedge that position. Then it comes to my mind that okay, a long call is a good option to hedge that. Right? So all I'm trying to make a point that the idea here is not to learn and to understand what combination would solve this question, but to really understand what is my requirement.
Yeah.
Perfect.
Perfect.
Let's proceed. Now let's talk about covered call. One thing that is important to remember is a covered call is a long a stock.
Yeah.
Thus sell or maybe short
a call.
But when I'm a longer stock, what is the need of selling a call? I don't understand this. Unnecessary.
Yeah.
Either I'm playing with options, good for me.
Yeah.
Either I'm playing with the stocks, okay, it's fine for me.
Yeah.
But I'm long a stock and I'm selling a call.
Yeah.
Why? What do you think would be the motivation? Acha, theek hai. I'll just help you out to understand.
Yeah.
Why would somebody sell a call?
To receive some premium.
Think about this. Selling a call.
Unlimited.
You have an unlimited loss.
Yeah.
Why would somebody do that?
Yeah.
There has to be bigger motivation, right?
Yeah. Not sure.
Okay. Again, let's talk about NBCC. By the way, I don't have a position in NBC. I just took some example.
Yeah.
So let's say you have NBCC stock, you are long NBCC. Current price is 100 rupees.
Yeah.
And you have been following this stock from quite a few months.
Okay.
Maybe quite a few months now. You know its daily potential. How far can it go? On a good day, on a bad day, what's the volatility, etc. So you know that in a week's time, the maximum volatility is 10%.
Okay.
I'm not trying to use some technical jargon on volatility, standard deviation. No, just trying to tell you a simple thing that you know from experience that the maximum that it could go is 110 or maybe 90.
Yeah.
But you want to earn some money. You went to the market and you saw that there is a there is a way that you can write a call as good as selling a call.
Yeah.
For a strike price of 120, and the premium that is being given to you is 4 rupees.
Yeah. Yeah.
Is that a bad deal?
It's not. Yeah, it's a good deal because it won't go above. Right? Yeah.
Because people who don't know might still think that it might cross 120 and then they can make money. But you in yourself would know that it would not go again. Everything is a probability, but then you're pretty sure that it will not go up to 120, and then this is an easy money that you can earn. Because you're selling a call, you are making the money. So if you are thinking that okay, I think that it will not go 120, or maybe the volatility is not too high. Yeah. Right. So you can easily make money just by earning 4 rupees without doing it.
Yeah.
Good enough motivation?
Yep.
Okay. Let's talk about another motivation. You have 1,000 shares of NBCC, right? And obviously the price is again 100. And you think that your actually buying price was 70 only, actual buying price. So you are anyways pretty satisfied with 100 rupees. So even if you go to the market and sell those, let's say you want to sell only half of the position. If you think that you want to sell your 500 shares worth rupees 100, that's a good money and you're happy with that. Right?
Yeah.
Since you are already in your mind, you already are trying to sell the stocks at 100, I would say, how about you sell a call with the exercise price of 101.
Okay.
Or maybe 100 itself. I don't mind. Right? The benefit is twofold. First of all, if the stock price is 100 rupees, for a strike price of 100 or 101, the premiums will be huge. Right? You understand why?
Yeah.
Because the the probability of getting it to 101 or 102 is too high, so the premiums are too high. So when you already have in your mind that you want to sell your position, you want to reduce your position, and if you sell a call, let's say at a strike price of 100 only, which is at the money, how about that you earn extra premium of 10 rupees? You were anyways going to sell the stock at 100 rupees, and now you got 110 for free.
Right.
There is no loss because you were anyways going to sell it at 100.
Yeah.
Make sense?
Makes sense.
Okay. And lastly, you want to sell your whole position. Maybe either you want to reduce the position or you want to sell the whole position. So you could get a question somewhere on these lines, that why would somebody buy a covered call, right? So the options, I mean, the motivations are, first, that you would know is that you want to, for yield enhancement, right? Maybe to reduce a position.
Yeah.
And third, maybe target price realization.
How is it reducing a position? The second one?
Yeah, it's not reducing a position, but from 1,000, you anyways wanted to make it 500.
Yeah. Okay.
Right? So you just sold those 500 at a premium.
Got it.
You sold the call, and obviously somebody is going to execute the call when the price goes higher. Right? So that way you can earn some extra. At the same time, you also reduced your position the way you wanted. Make sense?
Makes sense.
Okay. Let's just also quickly look at the payoffs, although we understand how the payoffs would look like for a covered call. Yeah. Without the call, our payoffs would have looked like something like this.
Yeah.
It's a simple long stock payoff. But then when you are going to sell a call, obviously at some desired price,
Yeah.
you are truncating your profits.
You are truncating the upside.
The profits.
Yeah.
Right? Because somebody is going to execute that.
Yeah.
So your profit will be truncated. So a covered call payoff would look something like this. Make sense?
Yeah.
Let's talk about protective put.
Okay.
In a protective put, you are long a stock plus you are long a put.
Okay.
Why would you do that?
You want to basically protect your downside, restrict it.
Simple, right? That I want to protect my downside.
Yeah.
Right? So if it is, this is stock this, I would pay a lot of money, right? Because this, when I buy this, I paid some money.
Yeah.
And even in put option, I'm long the put, so I'm paying the premium again.
Yeah.
So that way I'm spending a lot of money, but at least that way I'm securing my downside completely.
Yeah.
Again, how the payoffs would look like. This is of a regular stock.
Yes, correct.
And how would I protect my downside?
Basically, at a certain price. Hello, can you hear me?
Yeah, I can hear you very well.
Yeah, okay, got it. So you'll intersect over there. Okay.
So this is my long put.
Yes.
This is my long stock.
Yes.
Right. So this just offsets.
Yes.
So effectively, this is as good as a longer call, right?
Right. Right.
One more thing is sometimes it's easy to understand, although I have covered that already. But I just want to reiterate one more time. When it comes to covered call, what could be the maximum profit so that we have everything on one page? How much
Yeah,
would the maximum?
the maximum profit would be just thinking 1 sec. Maximum profit. Yeah, I understand the graph, but I just don't. I don't know what.
I'll help you out with that.
Yeah.
So, what did we say for a covered call? For a covered call, we do a longer stock.
Yeah.
And then we are shorter call. So leave this part for now.
Yeah.
You bought something at 70.
Yeah.
You sold something at 120.
Yeah.
What's your profit?
50.
So far, so good?
Yeah.
Now, you actually sold a call for a strike price of 110. Which means when the price goes above 110, somebody else is going to execute the trade and you will have to, your profit will be truncated. Remember this? The graph was something like this.
Correct.
So the maximum profit that you would get is not effectively ST now.
Yeah.
It is going to be X. Do you agree?
It's going to be X.
Yeah, the strike price. You know why? Because the moment it becomes 111, for the person who is long the call, you are short the call, right?
Yeah, he will execute.
Someone who's long the call, he has a right to execute and he will execute, obviously.
Yeah.
So post 110, he will earn the money. You will not earn the money. So the maximum profit will get truncated. I'm referring to this part now.
Yes.
Right? So your maximum profit is 110. Not the profit, but you will not make money after 110.
Yeah. Got it.
So can I say that the maximum profit could be X minus your S0, which was 120 minus 70 before, but now it is 110 minus 70.
Yeah, that's the maximum.
Right? That's the max that you could get. And obviously, when you have sold a call, you must have earned some premium.
Yeah.
Right? So can I say that in case of a covered call, the maximum profit could ever be X minus S0. I'm putting it S0, okay, not ST plus C.
Yeah.
Make sense?
Yeah.
Okay. How about the maximum loss?
Maximum loss is equal to minus S0, which is how much you've paid for.
What is minus S0?
How much you pay?
Oh,
The
yes. So the stock price, whatever you have paid initially,
yeah
which is 70 over here.
yeah
So if this becomes zero, your maximum loss is 70.
yeah
But you have sold a call, so you must have got some premium.
right.
So the loss would be minimized by the
Yeah
call option
yeah
that you have. Actually, this is minus 70 plus call,
yeah
right? And when I'm using the word loss, then I can write 70 minus call. Can I write?
70 minus
And
call.
I'm
Yeah
just using the word loss,
yeah
right? So can I say that this is actually S0 minus C?
yeah
Are we good?
yeah.
If you're not sure, do ask me again and again, okay?
No. I got
All right. How about in terms of protective put,
yeah.
what do you think would be the maximum loss, maximum profit?
That's unlimited.
Maximum profit is unlimited, perfect. How much will be the maximum loss?
Maximum loss will be basically your
The protective put, we are long a stock and we are long a put.
yeah. It will be just give me a second. It will be the strike price of the put minus the price at which you bought the stock minus the put premium.
Minus the put premium. Okay. So the maximum loss would be you are long a stock,
Yeah
so the maximum loss could be as zero,
yeah
but you are long a put as well.
yeah
So think about this. For a long put, by your profit though is unlimited because of
yeah.
this. What is the payoff of a long put?
It
X minus S0? Actually, S0 minus X. Actually, in terms of loss,
hmm correct.
right?
Yeah.
And then you paid the premium,
Yes.
right? So another money that you have paid. It's just a change of the signs, but what you have written is the same as what I have written.
Yeah. Yeah.
Think about this, right? S and P have the same signs, and X
Yeah.
is the opposite. But in terms of loss, so I'm not saying minus 3 profit. I'm calling it
hmm
as a 3 rupees loss. That's about it.
Yeah. Yeah. Yeah.
Right? Are we good?
Yeah.
Let's proceed. Okay. Uh, I'm just looking at the next topic. One second.
Yeah.
So the next topic talks about options. Although we covered that, but I just want to. They call it options as a hedge of a short position, right? But didn't we cover this? If there's a short position, remember the last question that we did,
Yes.
right? You were short the
Forward.
underlying.
Yeah. The forward one, right?
Yeah, exactly. So you were long a call and you were short a put. Remember? Make sense?
Yeah.
Let's just quickly solve one question and then we will proceed with the next topic. There is a stock price of 37.5. The stock price, not the strike price. A put of 1.4, a
hmm
strike price of 35. Right? Can you tell me the maximum profit, maximum loss, and break even.
For which strategy?
So I'm saying there is a person who has bought the stock,
Okay.
right? Buy the put.
And he's bought a put as well. Okay.
Yeah.
Yeah.
Which strategy it is?
This is a protective put.
Tell me the maximum profit, maximum loss, the break even.
Yeah. My maximum loss is, so 3.9 is the maximum loss.
3.9. Okay.
Maximum profit is unlimited. And your break-even point you've essentially paid 38.9. 38.9. Yeah, so break even is basically how much ever you've paid, that much amount of profit you'll need. So is break even like the ST that you're referring to, like what ST should be?
Yeah. But that's not really ST, but the concept is right that how much overall you have paid for
Yeah,
it
so
to make it.
you've paid 38.9. So
That's your
effect
break even,
got it. Okay. That's your break.
right? So you've paid the stock price and you have paid the put.
Yeah.
So anything you will make money
Yeah.
if the price goes above this. So that's your break
Yeah.
even. Make sense?
Yep.
Okay. Let's have one more. So there's this person ABC.
Mm-hmm.
He has a short position in PQR stock.
Okay.
He has a ABC is a person.
Mm-hmm.
He has a short position in PQR stock. The PQR, its current price is 220, right? And this person expects little volatility. Basically means low price movement in a short term. But his long-term view
Is that it'll
is
reduce?
bearish. Yeah. Now he's trying to increase his yield.
Yeah.
What he should do to increase his
He,
yield? Obviously, you can imagine when he's trying to increase his yield, he would sell something.
yeah, so you should sell a put.
Sell a put.
Mm.
So I'll give you three options and then let's discuss. The options are he should sell October. Let me see if they're mentioned. Okay, next month. Okay, or it's fine. October 240 call.
Hmm.
October 240 put. Or C. October 200.
October 200 put. So he should definitely, sorry, not do option B, because currently it's 220, and if he sells the right for someone to sell at 240, which is more than 220, that obviously doesn't work for him, right? Then he's left with selling October 200 put. October 240 call. So he can do either one of those, right?
Sorry, which one? Between?
A and C.
Okay.
And but he also, yeah, not sure.
So how's B out?
B is out because he's essentially selling in the money put, right? Hello?
Yeah, I'm thinking. For a B, you're saying he is selling in the money put. Okay. And how about A? What's the problem with A?
A, he's selling something for 240. The problem with A is that, no, I'm not sure what the problem with A is. Because he's not covered, is it? He doesn't have the stock.
Think about this. First of all, that we need to understand is he has a short position.
Yeah. So he believes it will go down. He believes it will go fundamentally down. It won't go up. So then, but he also believes that volatility won't be high. So currently 220, but we don't know what his gauge of volatility is. So
think about this. When he thinks that it is going to go down from 220 to 50, do you think selling a call would help him?
It would, yeah. It would, because he doesn't believe that the price of the thing will go up even above the strike price. So,
but does it help him?
so if he sells a call, he gets premium upfront for a call option that will never get exercised, right?
But think about this, right, Gaurav, that when he has a bearish view, it means the price will go down. So he would want to cover his position, right? If he is going to sell a call, this would have worked out if he has a long position. So if he would have a long position, then in that case, he would have sold a call so that he can earn and he can let go some of the profits and he can earn some money out of that long call.
Okay.
Out of the long position. But in this case, when the long-term view is bearish,
yeah,
right? When the long-term view is bearish, it is also important to understand that he wants to save his position from a short position. Okay, let's go again further from starting. I just read this out for you and then we'll rediscuss. It says it is September and Jones, when I'm calling it as ABC, has a short position in Alpha Corp. Then I'm calling it PQR.
Yeah.
It's a short position. Okay.
Yeah.
The share price is currently 220.
Yeah.
And Jones anticipates little movement in the price over the next month. Now, when he says that there's a little movement, it means the price is not going to change too much.
Yeah.
Right? When they say little movement, it means from the current price is 220, right? So we are only considering something in plus minus 20 itself, right? This 200 or 240.
Okay.
Although his long-term view is bearish.
Yeah.
When his long-term view is bearish, so everybody would want to get to a point where the price is lower, so the premium on a 200 would be higher than on 240.
The premium on 200 would be higher than the premium on 240.
Yeah, because the long-term view is bearish. So if the long-term view
But
is
that
bearish,
is okay. Got it. Yeah. Okay, makes sense.
so put will be more valuable
Put will be more valuable. Yeah.
in a bearish market, right?
Yeah.
Okay. Now, if but then since he is short of call, he would
Huh.
obviously want to keep his position. He would obviously want to keep his position, but what I'm saying is, since the volatility is low, but selling a 200 put will fetch him a good money.
Yeah.
Make sense?
Makes sense. Makes sense.
So you would see that the more it is about understanding what's going on than with than the actual calculation.
Calculation. Yeah. Yeah.
All right. Another interesting topic let's just discuss before we wrap up our today's session
Yeah.
is callers.
Is what?
Callers.
Callers. Yeah.
Okay. So a caller is basically, and then let me tell you, some people call it as a hedge wrapper.
Okay.
Actually, caller is a highly accepted word and used, right? But everybody knows that's a simple calculation of a caller. So what if CFA wants to trick you? Right? So I'm saying it's always good to at least remember the two names that they have: hedge wrapper or fence.
Offense. Okay.
Fence. Yeah. So I'm saying a collar is a combination of protective put
Yeah.
plus covered call.
Protective put plus covered call. Okay.
Now think about this. Let's just unfold this. Covered call is
You
covered
are
call
long
is
the stock and short a call. Protective put is stock, long put.
longer stock and
Long put.
so without getting into details, let's just quickly try to create a payoff one by one. Let's just do a longer stock and we have a common longer stock. Okay. So let's just do a longer stock.
Yeah.
Okay.
Yeah.
Let's just try to cover ourselves for longer put. If we are longer put, then
Basically, the left side gets cancelled out, right?
and when we are short a call,
We are the right side gets.
somewhere. Right? So so what we say is even though I created this as a long put, but we are not really offsetting the whole thing.
We aren't offsetting the whole thing. Yeah, correct, correct.
We are not. So what I'm trying to say is that let's say I have a long stock at 70. I'm long a put at 30
Okay.
and I'm short a call at 100.
Okay. Yeah. Yeah.
Right? So what happens
Yeah.
is that when I'm
You,
long a put at 30, so no matter if the price becomes zero, I'll get 30.
yeah. Yeah. Yeah.
So my payoff somewhere be around this at a 30, and then I'll use this till it reaches 100, and then it gets truncated.
Yeah.
Does that make sense?
So, but is there any downside to this? Like, it's like a what, a guaranteed return or what?
Uh, so the downside here is when you have bought till 70, your buying price is 70, right?
Yeah.
What if the price goes to 40?
40. Then you don't exercise put.
Huh?
No, I'm just thinking. Then you've lost 30, basically.
Exactly. And then let's just plus minus do something, right? This is covered call, so you will get something.
Correct.
And you have paid something.
Correct.
And they would not be equal for sure.
Yeah.
So can I say for a ending price as 40,
Yeah.
can I say that my profit and loss, let's just see, will be equal to, actually I have spent 70 initially.
Yeah.
I have also spent some P as a premium of long put,
Yes.
and I have received some C.
Yeah. Got it.
Yes. So so if the end price is 40, right? So my loss would be 30 rupees from my long stock.
So your maximum loss can be 40 and your maximum profit will be 30.
My maximum loss could be from 40, yeah, without the premium, right? That you
Without the
paid.
premium. Sorry. Yeah.
Yes, totally agree. And your maximum profit is 30. Perfect. Yes.
Got it.
Adjusted by the premiums, obviously.
Adjusted by the premium. Yeah.
Does that make sense?
Yeah.
So in a caller, you are giving away some of the profits. So I'm telling you the motivation of a caller.
Hmm.
So you are giving away some of the profit,
Mm-hmm.
and the amount that you received from giving away that profit,
Mm.
you are using that amount to hedge your downside.
Yeah. You'll use
And
that
somehow,
amount to buy a put, is it?
yeah, exactly. So
Yeah.
you're hedging your downside, right?
Got it.
So in a way, you are selling a call. Basically, you are getting away with your profit,
Hmm.
right? And you are using that money to protect your downside.
Got it.
And somehow, if your call premium is equal to put premium, then at a certain level, you truncated your upside and your downside somehow.
Yeah. Yeah.
Are you good with this?
Yes. Yeah.
All right. One more we can cover very
Yeah.
quickly. Last one is straddle.
Okay.
Straddle. Straddle. I would highly encourage that, when you go back maybe today or tomorrow,
Huh.
and maybe by end of this session, not today's session, but the end of this whole topic derivatives, right? The way I used to study when I was studying my CFA level 3, I used to just take a notebook and I just used to write every strategy. Covered
Hmm.
call, protective put,
Right.
caller, straddle, right? And then I just used to think, okay, इसमें क्या होगा? इसमें क्या होगा? Right? Caller में क्या करना है? Straddle में, so
Hmm.
that I would know.
Makes sense. I'll
If I
do that.
know if I know long put कहाँ पे क्या डालने हैं, then it is easy for me to create a profit, loss, and break even. That's simple.
Huh.
But if you forget that a protective put is long call plus long stock plus long put, then end of story.
Yeah.
ठीक है? Now
Yeah.
again, straddle. In a straddle, you are okay. Important thing about straddle is, in straddle, it will only work. The straddle only works because it's a very, very expensive strategy.
Okay.
And why I'm calling it is a very expensive strategy? Because in this, you buy a call and you buy a put.
Okay.
So imagine this is a very expensive strategy, and it is only going to work when you have a lot of volatility.
Hmm.
If the prices don't move enough, let's say you spend
Hmm.
5 rupees for call and 3 rupees for put,
Hmm.
and if the price movement is not 8 rupees plus minus here and there,
Mm.
then you will just end up paying the premium for nothing. So one question that could come up somewhere here and there, or you should know this concept, that in case the environment is less volatile, straddle is the worst of all.
Worst option.
You should not opt straddle.
Yeah.
But if you have a high volatility environment, then straddle could give you profits, a lot of money. The important thing about this is that we buy the call and buy the put at the same strike price.
Okay. Okay.
No matter how much premium that I'm going to pay, obviously it's going to be different.
Yeah.
Depending upon how the market perceives the movement.
Yeah.
So I'm saying, let's say for same NBC stock where the stock price is 100 rupees.
Yeah.
I'm going to buy my call at strike price of 100, and I'm going to buy my strike price of 100 for put. So the point I'm trying to make is, that you go left or you go right, I'm going to make money.
Yeah.
This is from my long call, long put. This is for my long put.
Yeah. Okay. Perfect. Right. Long call, long put.
Same strike price. But obviously you can imagine my actual profits are are going to be somewhere down the line because of the premiums that I've paid.
Yeah.
This is what I'm saying. Unless it's too volatile that it breaks even, it's a very expensive strategy. You are long a straddle. Right? So obviously, somebody who is short a straddle would go either above me. No wonder.
Clear.
Makes sense?
Yeah.
So, all right. So we are up the time. A few things that I want to highlight before we wrap up.
Yeah.
First thing is we'll start with spreads. The next class.
Okay.
Second thing is for this week itself, just for this week,
Yeah.
will you be? There will be only 3 sessions.
Yeah.
Right. But will you be comfortable? Let's say because we are in sync. Let's say today, tomorrow, and Thursday, and we'll keep Friday off, Saturday off, Sunday off.
Yeah. Let's do that.
Right.
Yeah.
So let's catch up tomorrow, same time,
Perfect.
17, 18, 19, and then we'll decide on the next week on Friday, maybe on Thursday itself.
Okay. Thanks so much.
Right. And one more thing is I wanted to tell you. Yeah. Are we okay with the speed, the concepts?
Yeah. No. This is perfect.
Okay.
Thanks.
Did it add some value to this session?
Yeah. Definitely.
Perfect. All right. So we'll start with spreads tomorrow. I'll just try to get the PDF of this book. So because I'm thinking because you already have your curriculum, so questions from Shweta would be a plus for you.
Okay.
Right. And we'll take it from there.
Done. Thank you so much. Thanks.
Right. Thanks, Gaurav. Have a good one. I'll see you tomorrow.